people understand that we get to a point where trust is no longer found within a treasury bond or a currency, but in something like gold. This is something that ultimately I think the world is moving towards. There's no other reason for it to have been reclassified tier one. And now they're trying to get it reclassified to a high quality liquid asset, which is even a little bit higher than tier one. And this is a situation where they understand that gold is, I think, the only thing that will inspire trust in a system that has lost a whole bunch of it. And maybe this is why they're all buying it. They're all repatriating it, and they're shedding debt instruments like treasuries to accumulate more of it.
According to the latest JP Morgan research estimates, gold prices are now expected to reach $2,500 per ounce by the end of 2024. The new estimates assume the Fed rate cutting cycle will begin only in November, while markets are fully priced in for a September cut. The strategists noted in a report published on July 15th that a weaker US dollar and lower US interest rates traditionally boost the appeal of non-yielding bullion, but gold's relationship with real yields has been breaking down since early 2022. According to Schectman, the proprietor of Miles Franklin, global trust is shifting away from traditional assets like treasury bonds and currencies towards gold. Based on fundamentals, AndySchectman believes BRICS nations are using profits from selling oil to the West to buy gold instead of U.S. treasuries. Data from the World Gold Council indicates that nearly a quarter of all gold demand now comes from central banks, with the People's Bank of China being the largest buyer. The recent expiry of the United States petrodollar agreement with Saudi Arabia, which has tied the country into selling only its oil in return for U.S. dollars, now also means it will be free to trade in other currencies. This is another bad omen for the U.S. dollar, marking its steadily declining dominance. From a technical standpoint, Schectman anticipates the currency launch could postpone until 2025 based on strategy. He predicts that the longer BRICS nations delay their new currency, the higher gold prices will rise, raising U.S. debt. At this year's New Orleans Investment Conference, author Jim Rickards explained how a gold-backed BRICS currency could function. He proposed that if a BRICS currency unit equaled 1 ounce of gold and gold's price rose to $3,000 per ounce, the BRICS currency unit would be worth $3,000. This would devalue the dollar in comparison, based on the weight of gold. Now, we present the clips of AndySchectman's. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I read an article that 70-80% of all the rare earths were produced in China and the Eurasian continent, but 100% were refined in China. That's kind of emblematic of it. But these other countries, so we have very little in the way of energy production and factory capacity. All the factories are in China. They make everything. We make nothing. And we're going further into debt, buying government debt. They're buying our debt, the UK is, and we're going further into debt in order to buy commodities like oil and energy production from the BRICS countries, who instead of, they sell us their oil. What are they doing with the proceeds? They're buying gold. Instead of putting it into treasuries, they're buying gold. And we're creating more debt in order to buy energy from these countries. They used to buy our debt, but now they don't. So we have to sell that debt to the UK and to the Cayman Islands and Ireland, if you believe that. But this is a doom loop in the respect that these BRICS nations continue to pile into gold and other commodities with the proceeds of the energy we buy from them and the commodities we buy from them, which only pushes those prices up higher. And when you talk about gold going higher, as part of the new BRICS currency settlement, which will be deliverable, this just falls right into the hands of the BRICS countries. So the longer they wait, the higher the price goes in gold, and the more reliant the West is upon them for these commodities. And at the same time, you have a massive growing mass. 59 more countries said they want to join, coming out of Novograd 2 weeks ago. This is something that when you have more and more countries sign on officially, all accepting a common settlement currency that is not US dollars, that is settling in essence in gold, which is 40% gold, which is deliverable, which is held within the own borders of these countries. And that's a very important point here. If you're in the unit white paper, it talks each one of these countries will hold their own gold. So when you see this mass repatriation effort. And in particular, India is a good example, repatriating 100 metric tons they've held at the B of A, excuse me, at the Bank of England, B of E, Bank of England since 1991. And all of the countries repatriating their gold from the New York Fed. Well, that makes sense. These countries understand they can hold their own gold. They'll continue to buy gold because it will be what they settle in, which has outperformed the bond market 2-to-1 over the last 25 years with no counterparty risk. So the longer they wait, the more countries join on, the higher the price of gold is going to go, and the more trouble that the West will have in I think finding natural resources and people willing to hold their debt. So would it surprise me if they issued it in October? No, it wouldn't. But I think it would also not surprise me if they waited another year, to your point, in 2025. And James Rickards has an interesting take on it. He says, yeah, it's all about mass adoption, that right now there's 10 countries that they can shop with if they had a common settlement currency. 10. What happens if it's 69? If they said, fine, the other 59 are in. Now you can buy goods and services from 69 countries instead of from 10, which was previously 5. And pretty soon you have such a massive swath of GDP, human population, commodities, shipping lanes, military might, that not only is it a massive, massive real entity in every single way, but then issuing that common settlement currency, it's almost 100% guarantee that it works to a massive detriment to the dollar, to the treasury market, and to the way things have always been in this country.
Regarding the sustainability of lowering interest rates, AndySchectman questions the feasibility amidst the extensive selling of U.S. Treasury bonds, particularly by major economies. He points to inflated risks and challenges the accuracy of official inflation figures, warning of potential devaluation of the U.S. dollar. Looking at CPI for the 30 years from 1989 to 2019, the average annual inflation rate was 2.5%. The Federal Open Market Committee, the arm of the U.S. central bank that makes decisions about managing the nation's money supply, targets a 2% inflation rate over time. The U.S. yields and dollar indexes slumped to multi-week lows on the subdued U.S. CPI inflation data. The 10-year U.S. yields slid 0.60% on Friday as the yields fell around 2% weekly. Despite market euphoria in assets like gold, Bitcoin, and equities, Schectman argues that these gains reflect excessive monetary stimulus rather than sustainable economic health. Let's get back to the interview.
I have a hard time. I've said forever, I can't imagine that they would lower rates, and they haven't so far. I mean, remember, there was going to be 4 or 5 cuts for sure, and then, well, maybe one, and then maybe none. Maybe they're going to raise, and there's $14 trillion in debt that needs to be retired this year as maturing debt, or to pay interest expenses, or to cover the ridiculous amount of irresponsible fiscal spending and deficits of our government. How the hell do they come up with that? Maybe you can, as rates have been going down, what you are seeing is the Fed intervening already through, as Jim Willey puts it, the UK and Ireland and the Cayman Islands funneling money under the table. Because look, when you have a situation where more bonds are sold than our bought, rates rise, right? But when more supply, that's more supply than demand. But when more bonds are bought than are sold, rates fall. So we're supposed to believe that someone is interested in buying our 10-year treasuries, and they are doing so to drive rates down. I just have a hard time believing anyone would be buying our bonds right now when we see Russia and China and Japan dumping our bonds right now. I have a hard, who the hell's buying it? Is it monetization? Look, I think it's important to remember, there it is right there. And I think it's important to remember.
He's a buyer of bonds right now, I hear.
Yes. Well, look what Ludwig von Mises said. I'm going to read it. He said, there is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as a result of voluntary abandonment of further credit expansion, well, we're not there yet, or later as a final and total catastrophe of the currency system involved. We're heading in that direction. You lower rates, you have acquiesced once again. You're just going to reignite inflation. Yeah, the numbers they tell us are all fugazi. You can't believe them. Inflation is way higher than they're telling us. And this is a politicized event by the Fed to lower rates 2 months before the election. yeah, if they do it, fine. But I think it's stupid, and they'll never normalize their balance sheet, and it just signals to the world, why the hell would you want to sell us your oil or your commodities for a currency that once again will give in to inflation over austerity, and once again is rigged. I mean, it's rigged in every way, even in the way that they measure all of the numbers to gauge their policy decision, including unemployment numbers. And if they hired John Williams instead of the Bureau of Labor Statistics, maybe we would be able to direct monetary policy to right the ship. But what they are doing by giving in and lowering rates is the worst thing that they can do, and just giving up on ever getting this house in order. And it would start with stop spending. And the spending that we do is ridiculous. $100,000 per second is the amount of debt that we are creating. That's $1 trillion every 100 days, and not slowing down. So yeah, if you believe that inflation is where it is, I got a bridge to sell you. And that's why you take a look at all of these markets that just keep going straight up when compared against, against like the 10-year treasury. When you're comparing it, all of these markets are going straight up. All that money that's been created and poured into the system, whether it be gold or Bitcoin or the S&P or the NASDAQ, all of these things are shooting up because of all this money, and that will just keep it going higher. So it's good for gold. It's good for the market. And ultimately, it's not good for this country. So yeah, they'll probably lower rates, but I think it's really a dumb thing because it's only going to make a bad situation ultimately worse.
Due to both policy decisions and international actions, the weakening of the US dollar suggests that the financial landscape will undergo significant changes in the coming years. Technically, August gold bulls have a strong overall near-term technical advantage. Bull's next upside price objective is to produce a close above solid resistance at $2,500. How do you see central banks' increasing shift towards gold and the potential introduction of a BRICS currency affecting the global financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.